The next wave of crypto adoption isn't coming from retail traders or degen projects. It's coming from banks, the same institutions that crypto was once designed to replace. But here's the twist. They're not joining the hype. They're joining the infrastructure. This is the institutional wave, the moment traditional finance quietly moves onto crypto rails. To understand this shift, we need to start where the last story left off: central bank digital currencies. Central banks are building digital money systems, but those systems alone can't connect the global economy. They still need bridges between countries, between banks, and between networks. That's where institutions like SWIFT and the Bank for International Settlements, or BIS, come in. They're building the connective tissue of the new digital financial system, and crypto technology is the foundation. Let's decode what's really happening. The BIS calls it Project Nexus, a global framework to connect instant payment systems across borders. Right now, national payment systems like FedNow in the US, Pix in Brazil, and UPI in India all operate separately. Nexus wants to make them interoperable, a sort of Internet of Payments, and the key building blocks are tokenization, digital identity, and blockchain settlement. Meanwhile, SWIFT, the network that already connects over 11,000 financial institutions, is running parallel experiments. In 2023 and 2024, SWIFT tested the transfer of tokenized assets across multiple blockchains, including public ones like Ethereum and Polygon. The goal isn't to launch a new coin, it's to make sure tokenized bonds, stocks, and payments can move seamlessly between traditional ledgers and distributed ledgers. In other words, the pipes of global finance are being re-engineered to carry both fiat and crypto-native assets. Now, let's talk about tokenization, the quiet revolution behind all of this. Tokenization means representing real-world assets, bonds, funds, cash, even gold, as tokens on a blockchain. These tokens don't change what the assets are. They just make them programmable, composable, and tradable 24/7. That's why major asset managers and banks are now investing billions into tokenized infrastructure. BlackRock, JP Morgan, HSBC, Citi, all of them are building or testing digital asset platforms. They're not betting on meme coins, they're building digital plumbing. So how does this tie into crypto rails? Think of crypto rails as the transport layer of the new financial system. The same way the internet standardized data transfer, crypto rails standardize value transfer. Stablecoins, tokenized deposits, CBDCs, they're all different interfaces on the same track. The moment banks realized that crypto networks could settle value globally in seconds, they stopped treating it as competition and started treating it as infrastructure. That's where projects like RLUSD, Ripple's new stablecoin, come into play. RLUSD will be backed one-to-one with US dollar reserves and issued directly on XRP Ledger and Ethereum. But the goal isn't retail speculation, it's to serve institutional settlement. Ripple has been quietly connecting with banks for years through its on-demand liquidity system. RLUSD completes the circle, a compliant, transparent bridge asset between banks, stablecoins, and CBDCs. It's not the only one, but it's one of the first stablecoins designed specifically for regulated cross-border payments. At the same time, fintech companies are embedding blockchain rails under familiar user experiences. PayPal's PYUSD stablecoin runs on Ethereum. Visa and MasterCard have both integrated USDC settlements through Circle. Stripe, once a Web 2 payment processor, now lets merchants accept stablecoins and settle in crypto wallets. This isn't theory, it's already live. The user may never see the blockchain, but the transaction rides on it. Here's the paradox. The more regulated this space becomes, the more it depends on crypto infrastructure. Why? Because the legacy financial system was never built for 24/7 interoperability. Every bank operates on its own schedule, its own database, its own messaging protocol. Blockchains, especially permissioned or hybrid ones, fix that by offering shared ledgers with instant settlement and programmable logic. For institutions, that's not ideology, it's efficiency. The BIS estimates that tokenized assets could exceed $16 trillion by 2030. That's not crypto speculation, that's mainstream finance migrating to blockchain-based accounting. But don't confuse that with decentralization. Most of these networks will be permissioned, closed, regulated, and integrated with compliance layers. Still, they use the same principles that public blockchains pioneered: consensus, transparency, and programmable assets. Now let's zoom out. When central banks issue CBDCs, and commercial banks tokenize deposits, and fintechs launch stablecoins, what we're really building is a multi-tiered digital money system. CBDCs handle interbank settlement. Tokenized deposits represent commercial bank money. Stablecoins bridge both to public markets. Together, they form the backbone of the next global liquidity network. The line between crypto and finance is disappearing. Swift's blockchain pilots, BIS's Project Mariana and Project Helvetia, and Ripple's RLUSD are all pieces of the same puzzle. Programmable money moving on standardized rails. The focus is no longer speculation, it's integration. But here's the important part. This institutional wave doesn't mean the end of decentralization. It means the infrastructure is growing up. The same technology that powered DeFi is now being rebranded as tokenized finance. The difference is governance. Who controls the validators? Who defines access? Who earns the yield? Institutions are entering the room, but they're entering our room. They're building on the rails we invented. So what should we watch next? Here's a simple checklist. 1. Watch for tokenized bonds and money market funds. If they start trading 24/7 on blockchain networks, the transition has begun. 2. Monitor interoperability projects like SWIFT's Blockchain Connector or BIS Nexus. If banks start sending value through them, crypto rails have gone mainstream. 3. Track stablecoin regulation. If RLUSD, PYUSD, and USDC become licensed under global frameworks, expect institutional liquidity to flood in. 4. Follow bank adoption metrics, pilot programs, proof of concept reports, or blockchain custody licenses. Each signal marks another layer of the financial system moving on-chain. So, will banks and fintechs take over crypto? Not exactly. They'll adopt its infrastructure, but keep its philosophy at arm's length. Crypto's permissionless frontier will always exist, but the bulk of global value will likely flow through regulated crypto rails. That's the compromise the world is moving toward: open technology, closed governance. In the end, the institutional wave won't kill crypto's ideals. It will test them. Because the more value moves on-chain, the more the world will need interoperability, transparency, and open standards, exactly what blockchains were built for. This is not financial advice. It's a framework to understand how the next financial architecture is forming, from BIS projects to bank pilots to regulated stablecoins, and why the crypto rails beneath it all may become the default plumbing of global finance.